Well, good morning, everybody. Welcome to the Reserve Bank. I'm Alan Bollard, Governor, and welcome to our June monetary policy statement. The Reserve Bank is today leaving the official cash rate unchanged at 2.5%. In our statement, we do note that New Zealand's economic outlook has weakened a little since our last forecast in March. The political and economic stresses in Europe, plus a run of weaker than expected data, means that our trading partner outlooks have worsened somewhat. Also, there's a small but growing risk that conditions in the Eurozone deteriorate more markedly than is noted in our forecasts. And for those reasons, we're monitoring Eurozone developments very carefully, given the potential for rapid change there. The recent increased agricultural production and weakened global outlook have driven New Zealand's export commodity prices lower, and the resulting moderation in export incomes, though that's been partially offset by the fall in the exchange rate, will weigh on economic activity here. In addition, we note that fiscal consolidation is also likely to constrain demand growth going forward. Well, offsetting these negative influences, we also note that housing market activity continues to increase, supported by recent drops in mortgage interest rates, and in addition, the program of repairs and reconstruction in Canterbury is expected to substantially boost construction in coming quarters. Overall, total GDP growth is forecast to pick up slightly to just over 3% next year. Given this economic outlook, inflation is expected to settle near the midpoint of the target range. It remains appropriate for monetary policy to remain stimulatory, with the official cash rate being held at 2.5%. Thank you, ladies and gentlemen. That's the press release, and we're happy to take any questions. To assist, John McDermott, Assistant Governor and Chief Economist, and Dean Ford, Head of Forecasting. Open for questions.
John Bollard, you seem to be feeling a bit more pessimistic about New Zealand's projected growth going out to the future as well.
Yes, this is a slightly softer outlook than we've had in the past, and the reasons for that are softer export commodity prices. Some statistical revisions that mean actually we didn't grow quite as much as we had thought through the last part of last year, so a softer starting position. But consequent on that, we've also got exchange rate down a little bit and slightly softer monetary conditions because banks have been cutting interest rates.
There's a suggestion, or at least a hint in there, that interest rates won't need, or the official cash rate anyway, won't need to go as high as it might have done in previous economic cycles. Is that a correct interpretation?
Yeah, we've felt that for some time. Of course, as we all know, we are in a new world now, and we think that, well, you'll see our forecast for 90-day interest rates. It's consistent with not having to push the OCR up for some time. And even when we look out further, we don't expect to see it having to go anything as high as in previous cycles in order to repress any inflationary pressures that might be out there.
Do you see any risk looking further out, though, in an extended period of extraordinarily low mortgage rates, that it might inflate another housing bubble? Do you see that as a potential problem down the track?
Well, that's something we will be looking at. We are seeing some increase in housing activity. We're not seeing it reflected through particularly on the prices or inflation cost side. We'll definitely be watching that. We have seen the banks over the last month or so push down mortgage rates. They're looking for more business. We've seen mortgage approvals increase a lot, but that's not really being translated through into new housing. That reflects some other things that are going on around churn, around people's bank deposits and auctions, I think. But absolutely, that's something we will keep watching. At the minute, though, we're seeing some increase in housing activity, pretty much on track with our forecasts.
Will you look at, if you're worried about housing, will you look at other ways of trying to clip the housing market bubble other than raising interest rates, such as ratios in terms of how much people can borrow, 100% loans, that sort of thing?
Well, we've got the tools in place should we need to do that, and we have speculated that were we to ever see something like the sort of activity that was there during the 2000s housing boom, that we would look to some of those other tools just as additional ways of helping basically keep financial stability. But that's, I think, quite a long way off. We're not foreseeing that sort of issue for a while. We think orthodox monetary policy would be very effective at doing that at the minute, given that New Zealanders are very cautious and that they also are either generally on floating or very short-term interest rates. So were that to be required, an increase in the official cash rate we think would have quite an impact. It's not on our horizon at the moment.
Has monetary policy reached a limit when it comes to stimulating that domestic demand in terms of the housing market and getting people borrowing? I mean, have you reached a point now where reducing it further wouldn't do much?
No, we don't think so. We think we're in a reasonably good position in the sense that, as required, the Reserve Bank could increase or cut the official cash rate and expect it to have some impact. But that's not to say that you can keep doing that right down to near zero levels of the interest rate. At that point, it can become a bit like pushing on a string. It doesn't have that much effect. And that, of course, is why a number of central banks have had to go to unorthodox ways of stimulus. We think we're a long way away from that.
Are you near the stage at presenting those plans for those sorts of policies for clipping the housing market to the Minister of Finance, as the Deputy Governor alluded to in a speech a month or two back?
Sorry, Nigel, can you just repeat that question?
The plans for those sort of macroprudential tools,
yeah.
Are you any closer to presenting those to the government? The Deputy Governor alluded to that in a speech a month or so back.
Yeah, we've had a number of discussions actually with the Minister and with Treasury on macro-prudential tools. We've laid out the areas where the sort of tools we think would be appropriate and the sorts of areas where we think they might work. As I said, we don't foresee us being in that sort of zone for quite a while. We're continuing to just finalise with the Minister the appropriate governance on those, which broadly is along the lines that we talk to the Minister about the big policy issues, but it's the Reserve Bank's role to put those things in place under the Reserve Bank Act.
Do you need to ask what some of those tools are? Remind us what some of them are?
Yeah, we've said core funding ratios for banks. We already have a core funding ratio. It's on a timetable where it's got to do one more notch. That's all out there in the marketplace. Possibility for loan-to-value ratios, but that's a very blunt sort of tool. It's not something that people are looking to at the moment. Counter-cyclical counter-cyclical capital requirements under Basel III, so requiring banks to hold more or less capital at different times of the cycle, and any other capital buffers that might be required at particular times. Some of those are things that are part of this very big move to increase bank regulation out of Northern Hemisphere Financial Stability Board called Basel III. We think they could, under certain circumstances for very limited times, have a useful additional effect for us. But we've only ever said that they're really additional tools, and we would be using them for financial stability purposes, not directly for monetary policy purposes. Assume that the official cash rate continues to be the instrument for that.
How concerned should we be about a potential growth rate not much more than 1%?
Yes, well, this does underpin our forecast, and it does reflect us doing more work, having seen some of the revised New Zealand statistics data on slower than expected growth rates over the last part of last year, to say, well, how much spare capacity is there in this economy, given we've been through such a long recession, and during that time there's been very repressed investment in new plant and capital, and that does take a toll on lower productivity. And you can see we've got lower numbers in there. Now, these are numbers that aren't observable for some time. They are quite important in our forecasts. You've always got to say there's some risk around those numbers. It could be that we've got a higher potential than that, but we're taking a fairly cautious approach to that. This is a phenomenon that a number of different countries in the OECD are seeing and going through after the global financial crisis. We've been scarred by that crisis and by lower investment through it. It will take some time to build up the productive capacity of New Zealand to get potential growth back onto the pre-GFC track.
You don't seem to be forecasting in here that the much chance of the government getting back into a surplus with its goal of the 2014-2015.
Our forecast differs a little bit from Treasury's on a couple Treasury's budget forecast on a couple of counts. One is, of course, we've got more recent data than they had. Secondly, we've got lower starting point data, and actually, they've got more inflation in their forecast than we do, which is good for tax, but of course bad for price stability. A consequence of all of that is actually we do have a bit of a different fiscal track. We take another 2 years for the government to get back into surplus, but there isn't very much in it, and this surplus is the difference between two very large numbers that will move around. So that our view is that it's going to take a little longer, but it's not a very big difference in view.
Governor, you talk about this investment drought in here as households and companies are unwilling to invest much. How are we going to break that investment drought if households and corporates remain so tight?
Well, we do have a view that households remain quite cautious, and that broadly they're interested in deleveraging and they're not taking on debt under the conditions they were previously, and that does come through in terms of slower consumption, slower growth track. But we do think, as we've said, that we're seeing some recovery on the residential investment side, some more building activity. The proof of that is really going to be in a quarter or maybe 6 months' time when we see how Christchurch goes and when we see how much that demographic demand for extra housing is being met in other parts of New Zealand. And it could be that there's quite a lot more activity at that stage. Our role, we think, is to ensure that we have price stability and broader stability across the economy so people can go on, make up their minds about their own consumption and their own investment in a sensible way and help do that for New Zealand's growth, rather than seeing a sort of consumption-fed bubble of the sort that we at times had during the 2000s.
Do those supply constraints in things like housing and skills, could they restrain you from responding with monetary policy if the European crisis worsens dramatically? Cutting rates.
Well, we're of course going to look at domestic factors and international factors, and indeed this forecast is one where we've got international risks and potential for a bit more domestic strength. That's always going to be the balance that we're going through. The European side is a significant risk, one that we're watching closely but haven't factored into our core forecasts here. If you were to see a real European or Eurozone meltdown, of course that's going to be reflected through in our forecasts. The channel for that will be through our exports, other country exports, commodity prices, and potentially changing conditions in the funding markets for banks in New Zealand. So absolutely that'll be a core issue that we would be thinking about in terms of monetary policy. If you had a booming building sector at the same time, you've just got to balance that out.
You mentioned in the monetary policy statement that there's going to be quite a bit of spending restraint by the government, which is going to be a factor in the economic outlook. Sometimes people say monetary policy needs mates. Does the Reserve Bank need the government to loosen fiscal policy to help it?
No. We think that the budget, from a monetary policy point of view, that's our interests, the aggregate level and the aggregate fiscal stimulus, we think that's been set appropriately. Of course, you have to keep a clear eye on sovereign funding markets at the minute. That's got to be a major focus. This does that. That's appropriate. It leaves more discretionary stabilisation to monetary policy, and we think that's appropriate.
The Finance Minister said yesterday that his main concern about continuing bad news from Europe was that it could create paralysis around business decision-making in New Zealand. What's the Reserve Bank's view on that?
Yeah, we don't see it causing paralysis in decision-making in New Zealand, but it is true that businesses here in some cases have been delaying investment at the margin because they're looking for more clarity in the world scene. Just like households have been on some of their consumption investment decisions. And like it or not, I think we're all going to have to continue to operate with this quite ongoing fragility and uncertainty coming out of Europe. We don't think Eurozone issues are going to clear up on Sunday after the Greek election or for some time after that. It's going to be a difficult area with a lot of smaller crises bubbling up. And the successful companies and the successful governments around the world and the successful households will be ones that manage to deal with that instability and get on with life. So that's the challenge, really.
The Finance Minister's talked about maybe 10 years of that sort of uncertainty. Would you put it that far out?
Well, I hope he's wrong, but who knows? We look back historically and you'll be aware of the very well-known set of studies that's been done by American economists Reinhardt and Rogoff on this, and they take a sort of a Old Testament biblical approach in a situation like that. There's 7 years of excess and then 7 years of want as we go through and get things back in order. And that's pretty much what historical average crises where you've got an economic and a banking crisis together, well, that shows.
You mentioned that that tale of woe in Europe is going to continue to have implications for funding costs for banks. You say here for some years. What does that mean for mortgage rates?
Well, at the minute that's not really being reflected through. We've got two quite different things going on. One is that world markets are pricing risk much more carefully. But on the other hand, there is funding around, and New Zealand and Australian banks are well funded at the moment. So assuming those markets don't close up more on us, these banks look to be well funded, and by their actions you can see that they are anxious to lend. Actually, they've been cutting rates quite consistently to try and get more demand for funds. So we're not particularly concerned about that. Actually, that's loosened monetary conditions. It's a bit of stimulus. We think that's not unhelpful for the economy at the minute. We, of course, just like them, they'll be looking to see whether they can pick up market share out of that. We'll be looking to see what it does on the overall borrowing and residential investment. At the minute, as we said, we're not seeing much. We're seeing small but not a lot of growth in borrowing from the banking system.
Can I just bring you back to Europe? You've obviously been at the helm through the sharp end of the global financial crisis. How worried are you coming to the end of your tenure about what you see in Europe? How much does it keep you awake at night?
Well, thank you, Corin. It's first of all, I've got a little way to go yet, and I'll be in front of you with another monetary policy statement in another quarter. I don't stay awake at night but partly because I've got other people who I employ to stay awake on my behalf. It's just been a disappointing recovery. It's sort of one that's a bit easy for us to look back on and say, oh, well, of course, from that depth of global crisis is going to be very difficult coming out, but we certainly didn't anticipate the sort of problems around the Eurozone sector and the extent to which the euro could go quite toxic for some countries. The problem for us is that it's very difficult to actually model particular channels by which this gets resolved, and therefore we can't easily put those sort of scenarios into our forecasts. We can think, like everybody else, of a whole range of different outcomes. We continue to think the most likely one is a euro muddle through, but that, of course, wouldn't be particularly nice either. We don't think things are going to collapse, but there's certainly a real possibility that you could get Greek exit, and that could either be handled tidily or in a very untidy situation which leads to further contagion, and that would be more concerning.
Dr. Bullard, you note in here that there's been a shift in the drivers of growth in New Zealand from the external sector to domestic demand. Is that concerning, and is it against the plan of this whole rebalancing towards exports and away from consumption?
Is that concerning? Well, no, I wouldn't say particularly. Of course, we're pleased to see domestic drivers of growth. The sort of external domestic rebalancing, of course, will be assisted by the exchange rate coming off. We think that is useful. Does it run against the plan? We don't have a plan, I'm afraid.
Well, fair enough. On the dollar, you still say it's elevated, like back at its 2011 levels. How elevated is it? How much do you think it's overvalued still?
Well, we look at it against the sort of drivers there, obviously, and we've always said that we think the significant drivers have been yield differences, not that important at the minute. Risk on, risk off, absolutely important. You tell me what's happening in Greece overnight, I'll tell you what's happening to the New Zealand dollar the next day. And commodity prices. We were particularly concerned a quarter ago where commodity prices had come off and the exchange rate hadn't. Now, some of that has happened now. Some of the exchange rate move has happened, and that is more helpful. But we still would have a view that it's higher than levels that would be commensurate with us reducing our external balance, and that's one of the measures we'd look at.
What would those levels be?
Look, we've got a number of different models that deal a number of different answers, and we don't put any particular number out there in the public arena.
The word depression has been used by some commentators in Europe with the worsening economic outlook over there. Do you think that word is realistic, or would you say it's over the top?
Well, we're not hearing people using that, and statistically it's simply incorrect at the moment, and we're not seeing forecasts that suggest that. Prolonged recession and disappointing growth in some countries, absolutely, but not depression. I think I should go back and look at their history books about what a depression's like.
Governor, does it concern you when you see reports that banks are offering 95% home loans, break fees are being paid, big discounts on legal fees, the sort of activity we saw from 2002 to 2007? Does it worry you that some people might take on too much debt, given that people are seeing these low interest rates for so long?
I think there's two things there. One is, are we worried by more competition amongst banks to find more customers? No, I think that's the market working like you'd expect it to, and it's basically good for borrowers. The other part, though, is would we be seeing anything building up which might be beyond the sensible sustainability of people to take on debt? We're not seeing that generally at the minute. We always watch things like loan-to-value ratios. There's plenty of examples where high loan-to-value ratios are quite justified. So it really completely depends on who banks are lending to under what conditions. We're not seeing a huge growth in that, but that was one of the things we saw in the 2000s, and we'll keep monitoring that. And were we to see a real build-up of that, we were worried about financial stability, absolutely we'd take action on it. We're not in that zone at the moment, despite your comments on Jim Mora's afternoon program, Bernard. Any more questions? Thank you very much. That's the end of the conference.